Do you have any queries that are taxing you? Long-term capital gains, short-term capital gains, taxes related to your home loan, or saving on all those taxes? If you have a tax query related to real estate, you've come to the right channel and you're watching the right show. Hello and welcome. This is Property Hotline with me, Kavita Krishnan, on Magicbricks Now. Our special guest today is Harsh Roongta. Harsh is a chartered accountant and a SEBI registered investment advisor. He joins me in the Mumbai studio. Harsh, welcome to the show.
It's a real pleasure, Kavita.
So let's kick off with a question that's come in on our Facebook page. Now, Amol Mavle wants to know if he can start claiming tax benefits basis a fit-out possession letter. You know, Harsh, this is very common nowadays. It's difficult to get an occupancy certificate. You know, typically we advise that move in only once you get an OC. But what most buyers are getting currently is a fit-out possession letter, which legally, I'm told, doesn't really exist. But can they claim tax benefits? How does the tax department look at it?
So, as far as the tax department is concerned, Section 22 defines what is house property. Please remember, the tax benefits are actually a tax. So, your rental income is taxed. From that you get interest as a deduction. When the property is self-occupied, there is no rent, and therefore you get only a deduction, and that is the tax benefit. Now, a rental can be taxed only when the property is ready. So, obviously, if the property is not ready, there is no question of the rental being taxed, and if there is no question of the rental being taxed, there is no question of allowing interest as a deduction. So, that is the background. Now, the department does not lay down what constitutes a ready property. Now, we know that in large parts of the country, the OC never comes, and based on a fit-out possession, people have been living in it for years and probably even decades. I think as far as the department is concerned, if you are in possession and use of the property, you will get the tax benefit. Of course, if you have rented it out, you have to pay tax on the rent as well. The only one issue that I wanted to highlight is if the fit out and the actual possession is happening in the same year, then this question is very academic, because it does not really matter, it does not change anything. This is only relevant where it happens where the fit out happens in 1 year, fit out possession happens in 1 year, actual possession happens in some later year, or maybe never happens
Harsh, essentially what you're saying is, if you've got a fit-out possession letter and you have taken possession after this, which legally is a big no-no, but if you have done that, if you're living over there, if you're paying electricity bills, if there are taxes that you're paying, you can use all of that and actually claim deduction on your home loan.
Oh, absolutely. Yes, you can.
Okay, so the tax department will not necessarily frown on it, because the tax department does not technically define what is ready property, what is possession. However, here's what we tell say on Property Hotline: fit-out possession is not possession. It doesn't classify as possession. So there is nothing called a fit-out possession. You need an OC, an occupancy certificate, to actually qualify for possession, because this means that the house is safe for human habitation. So that is something that you need to keep in mind if you do opt for this fit-out possession, because legally you're still not getting a hold of the title of that property. Moving on, we have an email query that's coming in. Rahul Manohar has written and says that if he gets paid by the government for land acquired by the government again under the land acquisition law, does he need to declare this amount and pay tax on it? So the government is paying him here. Will that constitute income?
It does not matter. Even a compulsory acquisition is transfer as far as the Income Tax Act is concerned. So if the government acquires your land, clearly you have to pay capital gains tax on it. You will have to work it out like a regular thing. Whatever the government pays minus whatever is your cost, and you can get indexation on it. I am assuming you have held it for at least 3 years.
But Harsh, that is not fair. I'm giving up my land to the government when I had no intention of selling it for probably some infrastructure project or something that's coming in. And if the government says, okay, fine, I'll compensate you for that, why should I pay why should I pay tax on it, capital gains or income tax on it?
Well, tax laws are not designed to be fair, Kavita. 1. 2, of course, if it is long-term capital gains, you have the ability to invest that in another residential asset If it is up to 50 lakhs, you can invest it in the capital gain bonds so that you don't have to pay tax. So if whatever consideration you receive from the government, if the entire consideration you invest it in capital gain bonds, either not the entire consideration, as far as capital gains bond is concerned, the capital gains portion if you invest in the capital gain bond, or if the entire consideration if you invest in a residential flat within the stipulated period, it will be exempt. Just one point I wanted to make: if this land is agricultural land, which in the large parts it is, if it is agricultural land that is at least 8 kilometers away from a large urban township, then it is not even a capital asset under the Income Tax Act, and then there is no capital gains tax. So that will be very specific. In this case, we don't know whether it is agricultural land, whether it is more than 8 kilometers away from an urban area.
Right. So key takeaway over there coming for you right on the top of our show: if your land is acquired for infrastructure or for any other purpose by the government, and it is agricultural land, it is more than 8 kilometers away from a city center, you need not pay tax on that money that you're getting from the government because it will not qualify as a capital asset. However, if it is within city limits or near the city limit, within that 8-kilometer radius, if it is not agricultural land, then you will have to pay tax on that windfall. Next, we have a question that comes in on our website, www.mbnow.in. Apota wants to know if rental income from property is taxable and if it should be declared. If you have income, you should ideally be declaring it. That's not a question I think Harsh is going to.
I think there is this saying that, if anything is income, it's taxable. I mean, unless it is specifically exempt. Anything that's not specified as exempt is taxable. So obviously, rental is not specified as exempt. Rental is an income. It is clearly taxable. You will have to declare it if you are otherwise liable to file a return. If your minimum income chargeable, if your income chargeable to tax is more than the minimum amount, which is 2.5 lakhs currently, if it is more than that, you better file a return and you better declare it. Just one thing, against the rental, you are allowed a deduction, a 30% standard deduction is allowed. So only say 70% of the rentals are taxed. And if you have paid an interest to acquire that property that is rented out, then the entire amount without any limit can be deducted from this. Typically that results in a loss, and that loss is allowed to be set off against either salary, business or any other income as well.
Okay, so essentially this is what Harsh is telling you. If you get income from property, that is if you are getting rent, then yes, you need to pay tax on that rent, you need to pay income tax on that, and you have to pay tax only on 70% of the rent that you receive on that property. Now, the rent that you receive on the property, you can also claim deduction on it. If you've taken a home loan to buy that property, then on the interest that you're paying on the home loan, the entire interest you can actually claim deduction on that. So that is an advantage you have if you have a second property that you have rented out. Very quickly, Harsh, before we move on to the next question, say I have bought property, second property, I have bought it on a home loan, I have not rented it out. Can I still claim a deduction, on rental income?
First of all, if you have a second property, then you have to choose one of the properties, and let us say the second property is the one that you choose. You have to take the deemed rentals into account. What you would have got as rent had you rented it out.
So that is whatever is the rental in the market.
Whatever is the rental in the market.
I don't need to show any paperwork saying that I've rented it out or I've not rented it out and all of that?
No. So if you have actually rented it out, it is the rent that you receive that is taxable. If you have kept it locked up, and that is the second property, then you will have to take what is called the deemed rental. What is the value?
No, in that case, do I have to show paperwork saying that, I have not rented it out, but this is the rental in the market, something like that? I mean, what proof do I show to the taxman?
So with the return, you can't file any proof. If your return is selected for scrutiny, then you might be asked to show some proof.
Okay. So in that case, I'll have to show some documentation. Okay, moving on, we have Ajay now, who's called in from Pune. Ajay, how can we help you?
I basically wanted to, I have made an investment in a property in Pune, 1 BHK property, and it's been 5 years and I am willing to sell it now. I wish to know how to handle the capital gains aspect with respect to the property which I am planning to sell off now.
And that's precisely why Harsh is over here. Harsh, how does he handle the capital gains aspect? He's held the property for 5 years now.
So, when you had bought the property, was it a ready property or was it under construction?
It was under construction.
And when did it become a ready property?
It became a ready property in 2011.
2011, and you're selling it off now.
Yes.
So it's still 5 years from a ready property stage to selling. It's more than 3 years. So very clearly, I think this will be treated as a long-term capital gains. So you can, whatever is your sales consideration, less your cost, which you can index so that you can increase it by the nominated inflation factor that the tax department gives out. That difference will be the taxable long-term capital gains. Now you can save on that. Have you calculated the long-term capital gains in this manner that we just spoke?
Yes, it works out to roughly about 20-25 lakhs.
Okay, good. So one way to save on this is that you can invest the entire 25 lakhs in capital gains bonds from REC or National Highway Authority of India. You can do that, and the entire amount will not be taxed. You will get 6% taxable interest on these bonds. Your money is locked in for 3 years. Post these 3 years, you can get the money back and then do with it whatever you want. Another option is you buy within a period of 2 years, you buy another ready property which is at least 25 lakhs, whatever is your capital gains, and in which case this capital gains will be exempt. Just take care that if you have not bought the property by July 31st, 2017, then to the extent you have not yet spent your capital gains, please deposit it in a capital gain account. So, to quickly summarize, an easy way is within 6 months of your sale, buy NHAI bonds or REC bonds, which will give you 6% interest. Second option is by July 31st, ideally by July 31st, 2017, buy a property, a ready property for the 25 lakhs capital gains that you have. In either case, the entire capital gains will become exempt.
Right, and also do remember that the investment in bonds, that is also capped. You can only invest up to 50 lakh rupees in bonds, and this can be held for a maximum of 3 years, right? So essentially what the bonds does is also gives you a 3-year window to look for, to identify property and to reinvest those gains in property, right? Moving on, we have Monica, who's dialed in from Mumbai. Monica, what's your question?
Good evening. My query is property, and in April I sold it. I had a gain of around 20.
Okay, Monica, there's some problem with the line over there. What we'll do is I'll have my team call you back so that we can get your question clearly. In the meanwhile, let's move on to another question, Harsh. This is coming on email now. Selvin Ferrao says that he's invested in an under construction property by Lodha in Thane on July 2013. Now, he took a loan of 40 lakh rupees from HDFC. Disbursement began from December 2015. Now, possession is expected in December 2017. He wants to know how and when he can claim TDS benefit as a salaried person. He also asks if he can get TDS benefit only after possession, and if so, for which year?
Yes, I can understand him being so perplexed. Yes, unfortunately, you're right. Any tax benefits, TDS benefits is just a method of getting the tax benefit. The tax benefits on the interest, or for that matter on the capital, is available only from the year in which the property's construction is complete and you are possessing it. We answered that in the first query itself. In your case, let's assume that by December 2017, the property is actually delivered to you and you take possession. The first year in which you can get any deduction or any benefit is the financial year that ends on March 31st, 2018. In that year, the entire interest payable for that year, which means the first 9 months during which the property was under construction, April 2017 to December 2017, and after possession, Jan to March 2018, the entire interest is allowed as a deduction to you, plus 1/5 of the interest that you have paid till 31st March 2017 will also be allowed. That will be allowed as a deduction in that year.
Is this in the sense that the 1/5 deduction that you can claim on the interest that you've paid, the 1/5 of the interest, is that part of the entire corpus on which you can claim deduction, or is it separate?
So 1/5 this year you can claim in the year financial year 2017-18, and equal installments you can claim in 4 later years as well.
Is that within that entire amount that you can claim as deduction?
So if it is self-employed, if it is self-occupied, if the property is self-occupied, then the overall limit is 2 lakhs, and it is both the deductions put together cannot exceed 2 lakhs. If of course the property is rented out, there is no limit on the amount of deduction.
So the deduction that you can claim on interest on your home loan is capped at 2 lakh rupees, especially if it is property that is self-occupied. This will include the 1/5 of the interest component that you've already paid earlier, before pre-possession what you have paid. This will also include the deduction on that. So you need to keep that in mind when you're actually claiming your deductions. However, like Harsh pointed out, if you have rented out the property, then theoretically there is no limit on the amount of deduction that you can claim. Moving on, we have LG Raghavan, who's tweeted in this question. Now, he wants to know if corporation and water tax can be claimed in tax exemption.
So that's an interesting question. If it is self-occupied, no, you can't claim it. If it is rented out, then the rental is considered after corporation tax. So rental minus corporation tax is considered as rental, and the standard deduction is allowed from that. The 30% standard deduction is allowed from that. Water tax is not deductible.
So again, it's more prudent to rent out your property. In that, from a tax point of view,
from a pure tax
perspective, yes. But not something that most people would look at doing. It really doesn't make sense. Moving on, we have a website query that's come in now. Nishit says that he lives with his parents in their home. He recently bought a house in the same city against a home loan. Now it's ready to move in. He plans to rent it out. He wants to know what the tax impact on the property is. He also asks how much of the interest on the home loan can he reduce from his total income. We've already answered this 2 or 3 times in the show, but let's answer it once again. Harsh?
No, so there is this added complication, I think, that he has added, which says that he's staying with his parents in the same city. No impact at all. So you have rented out the property, the rent minus municipal tax, that is treated as rent, 30% standard deduction, minus the entire interest payable on the loan without any limit, that is likely to result in a loss, and this loss you can set off against your salary income, or if you are self-employed, against your business income. There is no restriction on that at all.
So Nishit, taking that home loan and buying that home was probably the smartest decision that you have made recently. Moving on, we have Monica now. We've got Monica back. How can we help you?
Yeah, good evening. I'm speaking from Mumbai. My query is, I had sold a property in April 2015.
Okay.
And I got a capital gains of around 20 lakhs, which again I have reinvested in a property in Pune. So I have completed the deadline of July 31st. I had not kept the money in any account, the bonds or anything. It was just in my normal account. So will I be liable to pay any tax?
I think she should move it immediately into...
No. You sold it in April of 2015, right? And you have already paid that money, whatever capital gains you made, You have already paid it out to buy another property, correct?
She's already reinvested the 20 lakh.
Yeah, agreement has not been done, but the booking amount has been given.
Which is equal to, at least equal to the capital gains that you made, correct?
Yes, we have done that. Yeah.
Okay. So if you have already paid the booking amount before July 31st, then you need not, and it includes the entire capital gains, then you need not put any money in the capital gain account scheme. That should be okay. The only issue is that flat should be ready within 2 years from the date of transfer.
Yes, it will be done. Yeah. Okay, fine.
So Monica, I think that should relieve you a bit. But she also said that there is some money which is lying in her savings account. Now what happens to that money? Does she have to pay tax on that?
You don't have to pay tax on monies lying in the savings account if there is any interest that you have got on the savings account.
Because
that
this
will
was
be
income
taxable.
that came into her account, right? This is money
So that
that
would
came
be
in
on
as
the
income.
What is lying in the savings account, you only get interest. That interest is taxable,
interest is
but you get a deduction of up to 10,000 rupees under Section 80 TTA. So, I mean, there is no question of any tax beyond that.
Right. So no tax beyond the little interest that you would have probably earned on that money lying in your savings account. That's the only tax that you'll have to probably pay because you've already reinvested your capital gains. We have a caller from Ahmedabad now. Ravi Taneja has called in. Ravi, how can we help you?
Madam, I have two properties. One a residential plot and one my residence.
Okay.
I wish to sell both the properties.
Yes, Ravi, go on.
Madam, I wish to sell both the properties and reinvest.
Ravi,
And reinvest the same in a
okay.
new large property. Will I be eligible to get the reinvestment benefits in both the properties?
You have two properties, you wish to sell both and reinvest the gains in a third property. Will you get benefit? That's your question,
Yeah.
right?
Yes, ma'am.
Harsh?
Ravi, just one question. I think you mentioned that one property is a commercial property existing,
One is a residential plot.
residential flat.
Plot.
Plot.
Yeah.
One is a plot and another is a flat.
No, second is my bungalow.
Right. So one is a plot, one is a bungalow. You are selling
Yeah.
both and then you are investing it in a flat.
No, in a bungalow, new bungalow.
In a new bungalow.
In a new
Fair
bungalow,
enough.
okay.
Fair enough. And I'm assuming the time period you will maintain. So I think the treatment is a little different for the plot and for the bungalow that you have. For the bungalow, it is good enough if you reinvest only the capital gain portion. For the plot, you will have to reinvest the entire sale consideration. Okay, and they can be reinvested in a single asset. That is fine. You can reinvest it together in a single asset and you should be able to claim exemption. One exemption under Section 54F, which is for the plot, and one exemption under Section 54, which is for your existing bungalow. And you can claim that in respect of the investment in the new bungalow that you are planning to make. I don't think it should be a problem. I suspect the amounts are rather large and the exact facts will need to be looked into. So I would suggest that you take proper professional opinion which might be more germane to your own specific case.
Right, Ravi, we hope we've answered your question there and given you a direction as to what you need to do. But like Harsh said, it would make sense because there are two properties that you're talking of. You're investing in another third property. It's best that you get some professional help over there, right?
Thank you. Thank you.
Thank you very much for calling in. Let's move on to a Facebook query now. Chandan Kumar Chatterjee says that he sold a flat in February 2013. He invested the gains in another unit in 2014. Now, if he sells a second property at no gain, will he have to pay taxes on the sale of the first property since he held on to the first property for 3 years? That's a very interesting question there, Harsh.
Let me just rephrase that. He had a property which he had some capital gains.
Right.
Then he reinvested those capital
In
gains
another
within a
property.
time period in another property. And it's not clear whether he claimed exemption on that or he didn't.
He doesn't say that,
He
but he
doesn't
says
say
that.
that.
He sold the second property
Without any capital
without
gain.
any capital
So on the
gains.
sale, if he has not claimed exemption of capital gains that has occurred on the first property, when he bought the second property, if he didn't claim any exemption, okay, then there is no question of any taxability on the second property sale, because he bought it for a price and he sold it for the same price. On the other hand, if he has claimed exemption of capital gains that he got on the first property because he invested in this second property, then the manner in which the capital gains is calculated for the second property will change. The cost of the second property, from that, what the amount that will be reduced is the exemption that he has claimed. That will be treated as the cost, and because he has sold it at his cost price, the difference will be a short-term capital gain on which he will have to pay tax.
So essentially, if he's not claimed, if he's already claimed capital gains exemption on the first property, then he will have to pay. He's liable to pay short-term capital gains
Yes.
on the sale of the second property. Moving on, we have Hari Babu who's called in. Hari Babu, how can we help you? And you need to be very quick because we have hardly any time left on the show.
We have purchased a property, taking a bank loan. Now we are unable to pay that loan, so bank is auctioning it.
Okay.
So we don't get any money out of it. Whether I want to know whether we are liable to pay capital gains tax.
Okay. The bank is auctioning his property. Does he have to pay capital gains tax on that?
Absolutely. Unfortunately, the answer to that question is yes. If there is a capital gains on that, whether you receive any money from the bank or not, it is that does not matter. The property has been sold. If it gets sold, you will have to pay capital gains tax on that thing, irrespective that you didn't make any money from there and the bank has appropriated the entire amount. That is the law.
That is a law, Hari Babu. Unfortunately, if the bank makes money on that property, you will have to pay capital gains tax on that. Harsh has something else to add. Harsh, very quickly.
The bank cannot keep money if it is received more in the auction than what is due to them. Any surplus, they will have to give it to you by law. That is also the law.
Okay, so they'll have to give you the surplus, but you will be taxed for that surplus. With that, we are coming to an end of Property Hotline today. That's it on the show today. But if you have any queries related to real estate, do get in touch with us and we'll get the country's top experts to answer each and every one of them. Harsh, thank you very much for coming in and answering all those questions. Thank you very much for tuning in to Property Hotline. Keep watching Magicbricks Now.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.